Okay, so today we cover deemed disposals. They are covered by Section 8.2 and Section 13 of the Capital Gains Tax. So we defined what we mean by deem when we started taxation. We say if we say we deem something to have happened, it really means that thing never happened, but we assume that it happened. So that's deeming. Okay. So sometimes we deem that a certain income stream is from a source within Zimbabwe. Sometimes we deem that it's income, but if you look closely, like motoring benefit, if you are enjoying free use of a company car, we can't really say it's income to you because what are you really? Let's say you are not even being given fuel and you are using your own fuel, they say you are benefiting, and the benefit is deemed to be equivalent to the engine capacity of the car. So that is deeming. There is no really income that is accruing to you, but Zimra assumes that you are earning income. So that's what also Zimra would do under CGT. Sometimes you might have not sold anything, or maybe you donated something. Then Zimra will say it was actually a disposal. We deemed that to be a disposal. So we have those instances. Number one, according to Section 8.2b, donation of specified asset. Uh, that is a deemed disposal. If you donate a specified asset, uh, please remember the definition of a specified asset. Maybe for the sake of those who join today, we can just cover these slides. Do not have that definition, but these ones they do. Okay, maybe just cover a little bit of the definition of a specified asset. We said a specified asset is immovables, e.g., land and buildings, and then any marketable securities, e.g., debenture shares, unit trusts, bond stock, and bonds and stock. And number three, this is important. A specified asset also effective 1 January 2017 includes, so it's saying with effect from one, who is joining this time? People are always late, whether it's physical or it's online. Okay. So we said with effect from 1 January 2017, the definition of specified asset now includes the following: any right or title to tangible or intangible property registered and required to be registered in terms of all these acts: the Minerals and the Mines and Minerals Act, the Patents Act, the Trademarks Act, the Industrial Designs Act, the Copyright and Neighboring Rights Act, the Geographical Indications Act, the Integrated Circuit Layout Design Act. So if you see anything that is required to be registered or that is already registered in terms of these acts, you know that it is included in the definition of a specified asset. Sometimes they put softwares, they put trademarks, you know that they are all included. Those software they are included on. What about software? Which act requires software to be registered? Uh, the Copyright and the Neighboring Rights Act, maybe. But if you see any, so if you look closely on these, all these acts, they govern intangibles. That's why we said specified assets, immovables, marketable securities, and intangibles. Okay, what about goodwill? So we go back to our slides. So let's say you donate your shares in Edgar's, or you donate your shares in Delta or Ibo Valley. Zimura to them is a deemed a disposal. So they have to account for the capital gains tax. But the problem is what will be the gross capital amount? I assume that now you know the framework uh, that we use when calculating a CGT. So the framework is this one. This was just extracted from Tabera, so you should have this one. So we start with the gross capital amount. This is just equivalent to the proceeds. If you sell your asset for 10,000, Then 10,000 is the gross capital amount. Okay. Then we say less recoupment. These are just capital allowance previously granted on that asset. Then we say less exemptions. Normally, we do not have much exemptions in CGT, except if an elderly person sells marketable securities, or if an elderly person sells a passenger motor vehicle. So everything is exempt. Okay. If an elderly person sells marketable securities, not everything is exempt. Last time we checked how much was exempt, by the way. I know last year it was 18,000. You have to check that one, but not everything is exempt. Then after deducting exemptions, then we have capital amount. So that means capital amount is gross capital amount, less recoupment, less exemptions. Then we less deductions. Deductions we have cost of certified asset, improvements, additions, alterations. Uh, then we also have inflation allowance on the cost and also on the improvements. Then we have capital allowances. So this capital allowance will be equivalent to the recoupment. That so normally we don't actually account for recoupment and capital allowance because the effect is zero. If we deduct it on the gross capital amount and deduct it from deductions, the effect is zero. So that's why sometimes we don't really account for that one. But if you want to be good, you should know how to account for that. Then after that, if we had selling costs, and we also they are also in a allowable deduction. Then we have our capital gain. Then we less any reliefs. We cover reliefs today. Then we have capital gain or loss. Then we charge our um, our capital gain tax depending on when the asset was acquired and sold. Okay. So in the case where you donate a specified asset, so your gross capital amount will be equal to the fair market value of the asset. So Zimra will just say, okay, you donated your shares. If you had sold the shares, how much were you going to pocket? Then you say, I was going to pocket 10 US dollars per share. So they said the number of shares that you sold maybe 100,000 multiplied by 10. So that will be the gross capital amount in the hands of the donor. So that is just one example of a deemed disposal. Another example of a deemed disposal in terms of Section 8 to C is expropriation of specified asset. Okay, so expropriation of a specified asset, amount of compensation received is gross capital amount. So by expropriation, we say the asset maybe was damaged or it was stolen. Okay, so and you had insured the asset, the specified asset. So when you get the insurance, whatever amount that you get from the insurance, that will be your gross capital amount. Then you account for the other deductions and those other adjustments appropriately. Then number three, section 8.2D also deem sale of specified asset through an execution of court order. The price at which asset was sold shall be deemed to be due to the person on whose behalf asset was sold, despite there being no proceeds which may be received by the owner or accrue to him. So let's say there is a court order to sell your assets so that they can pay your creditors. You might not receive anything from the sale of that asset, but Zimra will say you have sold an asset. So you have to pay capital gains tax. Okay, that is just too much, but those are uh, the deemed disposals. Number four, section 8 to E, maturity redemption of an asset. Asset is deemed to have been sold by the investor on the maturity date and for the maturity proceed value, e.g., redemption of preference shares by a company is a disposal in the hands of the shareholder. Value in cash amount or value of equity preference shares are exchanged for. So we know the redemption. We know how the redemption works, isn't? When your shares, maybe with a holder of preference shares in a company, and now they are redeeming because now they have reached their maturity date, or it's a debenture. You are the debenture holder, and now they are redeeming the debenture. So it's a deemed disposal because we know that the preference shares and the debentures are marketable securities. So they fall within the definition of a specified asset. So when they are redeemed, it's a deemed disposal. We have to account for capital gains. And what will be the gross capital amount? It will be the proceeds, whatever that you are receiving from the company will be the gross capital amount. Then another deemed disposal is in terms of section A to F, transfer of rights under a deed of sale. Okay. The amount received on transfer of the property into the name of the buyer is the gross capital amount in the hands of the seller. This is the selling price with the amount of sale and includes installments not yet due and payable. Then last number six is in terms of section 13, it's compensation received from damaged asset. Okay. So that time we had the expropriation where the asset is stolen. Then now we have section 13, compensation received for a damaged asset. This one is very important. Section 13, section 13. I repeat, section 13 is important. So we have to go and actually read from the act because this one is important. We'll see how these slides will try to cover it, but it's always a nightmare. Okay, so this is just a summary uh, of a deemed sale type and also how we are going to derive the gross capital amount from that type of disposal. So donated asset, we say is fair market value. Then sold by expropriation, that will be compensation received. Then sold in execution of a court order, then the selling price. Oh man, I'm going to take. Okay, anyway. So a sale sold on execution of a court order, then the gross capital amount will be the selling price. Then on maturity or redemption of a specified asset, then the maturity proceeds will be the gross capital amount. Then a deed of sale, the full selling price is per the sale agreement. Then we'll cover the deed of sale in depth in terms of section 17 and 18. That's where we have issues of suspensive sales allowances there. It's also a very important topic. Then number six, compensation received for a damaged asset. The gross capital amount will be the compensation received. We have issues where there might actually be a sale or a deemed disposal, but we say the capital gains consequences are new. So that's why the slide is saying new capital gains tax cases. Okay, so this one is in terms of section 15, subsection 1. If there is a transfer of a specified asset between companies under the same control in the course of a group restructuring or merger, there is no capital gains. There are no capital gains consequences. Okay, so if Gwanda University transfers an asset to NAST, there is no sale there because Gwanda University is just a subsidiary of NAST. There is no capital. There are no capital gains consequences there. Okay. Or maybe if we are going to use a more practical example, if Edgar Stores transfers assets to Jetty Stores or to Carousel or to Club Plus, there won't be any tax consequences. If Econet Wireless transfers an asset to Stewart Bank or to Cassava Smartech, or to whatever other companies that are under Econet Group, there won't be any capital gains consequences. That is in terms of section 15.1. Then section 15.2 is say if there is a share swap between companies under the same control in the course of group's restructuring or merger, again is almost the same as section 15.1, but now it's just a share swap instead of a transfer between under of special assets between companies under the same control. Then section 16 says transfer of assets between spouses. So if I transfer an asset to my wife, if I have one, then there are no capital gains consequences. And the if also the wife transfers an asset to me, then there won't be any tax consequences. This also holds even in divorce cases where my asset is now being taken by court and given to my former wife. She is also still considered to be my spouse. So there won't be any capital gains consequences there. Then section 17, transfer of business property by individual to a company under his control. So if I now say my car right there, I want to start a business, I transfer the car to Nitt-Gritt, there won't be any capital gains. Whatever. A car is not a specified asset. You were supposed to say that. Maybe it's my house, and I now want to convert this house into a business property. Then there are no capital gains consequences there. In all these cases, the property will be taken as if it has always been owned by the transferee from the time it was first owned by the transferor. Okay, so the effect is we just transfer the asset at ITV. That is what this statement is all about saying. So there won't be any tax consequences. Okay. Okay, now we cover a little bit in detail the transfer of asset between companies under the same control. Section 15.1 that we covered on the previous slide say where a business combination is applied by the Commissioner General, e.g. a reconstruction, a merger, is approved. Where a business combination is approved by the Commissioner General, e.g. a reconstruction, a merger or a takeover scheme, an election is available to transfer assets at their base cost. Deductions available on the asset under Section 11 of the Capital Gains Tax Act, notwithstanding the amount actually paid for the assets. Okay, so what we are saying here, there might be a reconstruction or it is any form of a business combination. And if that business combination is approved by the commissioner, then you, the parties involved, you should agree or you should make an election. So if there is no election, then this transaction is not exempt from capital gains, but we have to make an election to say we want to minimize tax liability. So that will be the election. So we won't account for capital gains. We just transfer the asset at their ITVs, not the actual amount paid. So maybe the ITV was 50,000, but you actually paid 70,000. We assume that we transfer the asset as 50, not at 70. So there won't be any capital gains consequences. Thus, no. Is that a question? I see. Okay. Okay, that's no C. Capital gains tax arises at the time of transfer that is triggered by the business combination. The capital gains tax will only arise when the asset is subsequently sold to third party that is outside the group. The commission general will be calculated. The capital gains tax will be calculated as if asset has always been owned by the transferee, e.g., that is as if it is the transferor who is selling. Then recoupment is taxed on the hands of the transferee. Okay. Base cost. The deductions are available on the asset under Section 11 of the Capital Gains Tax Act in the hands of the transferor. For instance, the sum of the um, of the cost, the improvements, the inflation allowances, the selling cost, if available on the particular asset that was disposed, e.g., the acquisition cost, the improvement, the inflation allowance, the disposal cost, etc. When an asset is transferred, its base cost, the transfer makes no capital gains, no capital loss. Okay, so this is just explaining what we're saying. Don't Where did we get the base cost? On section 15.1, it was saying where a business combination is approved by the Commissioner General, e.g., reconstruction, a merger, or a takeover scheme, an election is available to transfer assets at their base cost. So we are saying the base cost, we are going to add the acquisition cost, the improvement cost, the inflation allowance, the disposal cost. If they're 100,000, then we say we are transferring the asset at 100,000. So the effect is that there is no capital gains, because if we assume that the base cost is now our gross capital amount, if we say now that gross capital amount minus the base cost, still there won't be any loss or gain. That's why we say we have to transfer the assets at the best cost. And this slide was defining what we mean by best cost then, best cost then. Okay, that is why we had this nice slide. ITV, we know that is net book value if we are in accounting. Given an ITV and the original cost of an asset, one can calculate the capital or granted and the equipment on the sale. What about if there is a share swap between companies under same control? That was governed by Section 15.2, if you remember that other slides. Where shares are exchanged for no cash consideration between companies under the same control in a reconstruction or major scheme, or when a ZIM subsidiary of a foreign company conveys to a local company, no capital gains tax liability shall arise. Election to transfer the shares at their best cost. So we have to make an election. The commission, the capital gains tax will only arise when the asset is subsequently sold to third parties. I think we covered this one. Transfer asset between spouses. What is the effect? Where any specific asset, including a shares, is transferred between spouses, or a private principal private resident is transferred to a former spouse through a court order for maintenance, or the true may elect that the price be deemed to be equal to the deductions allowable to the transferee. That is the base cost. If you remember that slide, that was defining the base cost. So we elect to say we are transferring this asset at base cost. That is the total allowable deductions on that transaction. Therefore, the effect is there won't be any CGT implications there. The CGT will be calculated in the hands of the transferee as if the asset has always been owned by the transferee. That is, as asset has at all times remained in the hands of the transferor. That is, as if it is the transferor who is selling. That is, transferee is deemed to have acquired asset at the same deduction as the original owner. We've been singing about this. Let's not waste time on that one. Then we have a transfer of movable business property by an individual to a company under his control that is governed by Section 17. The property must be used for the purpose of his trade. Those are the conditions. Is it someone who want to join? Let me just check. No one. Okay. Okay. So these are the conditions. Is that a question? Look, someone is is not on mute.
There's a question on the chat box, Joseph.
Let me see. Let me see. Can we slow down a little bit? Say, struggling to keep up. What are you keeping up with? Let me see if it will record.